Hello, my name is Tanya Baber, and you've joined us on the Offer in Compromise Intermediate. Throughout the course, what we'll be covering in the next couple hours, we will be covering the calculation of the all-important RCP, Reasonable Collection Potential, and, of course, the financial analysis, how to perform that. We'll look at in-depth detail of the asset equity table, looking at the assets and equity that's involved in the calculations, the income equity table, income, expenses, and plenty of information in the standards that they apply. So we'll touch on how that's done and a lot of techniques for you there. And perform a RCP summary, look at the bottom line, and throughout the course we'll be looking at a lot of tips for writing better offers, so that way you have tools that can help you as you progress forward considering offers in compromise for your clients. So we'll go ahead and dive right in. Now at this point in time, we're already going to expect that you know some of the basics about offers in compromise, that you understand there are 3 different types of offers, you understand what the requirements are, and some payment methods. So we're not really going to touch on that. We're just going to dive deep into how to do the important things for the financial summary and the RCP. So I want to just touch really quick on the reference information. This basically, we've put together a supplemental document that has plenty of information for you. The important thing is to know that this changes frequently. You just need to know where to find the information right from the IRM, from that Internal Revenue Manual that you know I like to speak about a lot. Again, if you want to find the Internal Revenue Manual, it's at irs.gov. You go right to the upper right-hand corner in the search screen and type in IRM, hit enter, and you get the Internal Revenue Manual that'll pop up. So that's an important aspect of it. We're going to spend a lot of time in IRM section 5.8.5. You will find in the supplemental documents we've attached, that's pages 2 through 37. We've captured it as of this moment in time, but it does change on occasion. That IRM section 5.8.5 is specifically financial analysis as it relates to offers in compromise. We will also have the collection financial standards as of 2017 included in pages 38 through 51. We're going to spend some time on those standards and talk specifically about property exempt from levy. And we've inflation adjusted those amounts for 2016 and 17, included those in your reference and supplemental information as well, so you know what's contained in there. And that's really just for your take-home use. We'll be covering all that and giving that information to you in the slides and as we move forward in the course today. So just to touch again on real fast, the pros and cons of an offer. It is a permanent contract unless the taxpayer happens to violate the terms of that contract. It provides them a fresh start and reduces the liability overall. Stops collection activity the moment they submit an offer, but we have to consider the cons as well. So that is that, yeah, we have to worry about the statute of limitations considerations, because the moment we file an offer, it puts a stop to the statute of limitations. And honestly, if they only had a few months left, it may not be best to consider submitting an offer, as it stops the statute of limitations, and maybe that is a better route to consider. They have future noncompliance worries that if they are not, they're kind of on probation, if they're not filing the returns on time every single year for 5 years after an offer is accepted, and they're not making sure they have no balances owing. This is the area where they can sometimes mess up. And so I'd recommend this could be a possible extra revenue for you, like a monitoring program or something that helps to make sure they're in compliance for 5 years after, just to make sure your offer doesn't then revert back and get voided. Because that happens, you've just provided the IRS with an entire map, a roadmap to all that client stuff. Remind the client again their future refunds are kept through that offer year. So these are just some real quick, let's say, recaps as to what we need to know as we're putting together an offer in compromise. And they can still file that tax lien, and they won't release a lien if there is one on a client's account until all terms of that have been satisfied. So we want to look really deeply into all of the financial information forms. We want to look real deeply into what it is that we need to look at. And the starting points of every collection case really is the financial analysis. If the taxpayer is already compliant, they file the returns, we have an idea what they owe, we can use these forms in collections to analyze finances, and it's the only way that collections will work with them too. Often we work through ACS for most cases, but the dollar value actually determines who we work through. ACS doesn't handle really big cases anymore, so it's out of a different division. The large collection items have to go through a different division. So it's important that we know who we're working with and which forms we need. So as we go through the 433A OIC, it's the doubt as to collectability and effective tax administration offer and compromise only. Doubt as to liability, again, does not require any financial information. No type of a 433A is required. If it's a business, we're going to be using that 433B OIC form, and this is for all business types except for our sole prop following their legal formation. So I sometimes get this question because we'll have somebody who has a sole proprietorship. They're going to fill out their business income and business expenses and business assets all within the 433A OIC. They have to make sure to include that in there because that business does potentially provide them a little bit of asset value or a little bit of income per month, and that's the only way you can account for that properly. And if it's a corporation or partnership or an LLC, you're going to fill out that 433B, do the same calculations, and just transfer asset amounts if there's equity in there, and you may transfer remaining monthly income amounts over back to your 433A. And you have to include both those. It's not that if they have one of these entities that we can not include that information. So just know that's what you're up against and what you'll need to include. And if it's multiple businesses, multiple forms, just know that's what you need to do today to do a proper offer. All right, as we get more into how we perform a proper financial analysis, the 5.85.5, the offer financial analysis section, if you're following the supplemental information, this is where I start. I just lay out the whole IRM for you. But it's important in this case that we consider this is their rule book. This is basically their standard operating procedure. But we have to be careful to know it is under penalty of perjury. So IRS will prosecute. We have to make sure it's filled out honestly. There's no hiding of assets. There's no lying whatsoever on here, because what happens is that they think that that's going on. It's a very easy recommendation from them going from an offer and referring it into CI, which is the Criminal Investigations Division of the IRS. So we have to stress that to our clients. They're the first ones to blame us as the accountant if they get into trouble, if things come into question. They'll just say, well, that's my accountant. That's what they did. So if we're discussing this case in front of a revenue officer and they bring up something we're not aware of, it also could damage our own credibility as well as that case. So we don't want that revenue officer saying, oh, what about the boat that they own and keep docked at the lake all summer? Because remember, they have access to third-party information and they have detective skills we do not have. So full disclosure is so important in making sure all those lines have a dollar value on there. We also have to consider the internal resources they have. They have access to all kinds of databases that tell them and cross-reference business activity that maybe they haven't listed, compare amounts of reported income and expenses, and they can verify if the amounts are within reason. So their internal databases are pretty exhaustive. But then they can go through and they can look at real estate, mortgage interest accounts, look for accounts not listed, like maybe a CD or investment account, verify sources of income like employers, bank accounts, retirement accounts, look for possibly recently transferred or disposed of assets, stocks, bonds. We're going to cover dissipation of assets later on by the way. They might be able to look at state motor vehicle records, tell them how many they're currently registered to, but maybe they're not declaring them on this information statement. They're also supposed to search under the business name too, if applicable. So they have a lot of these resources. It's not like that they're in the dark here. Real estate records, they're going to see what kind of real property that's titled to them, held by a transferee, nominee, alter ego, business entity. So it's a pretty exhaustive list. They have something called an accurant. This is an interesting database. It shows other possible aliases. It's related to business entities, UCC filings, properties, judgments, vehicle registrations, everything that might relate to this person, because they're going to try to see, are you really giving us everything here? They can also on occasion look at a credit bureau report. Now this gives specific instruction in the IRM about how they're to handle this information to protect the taxpayer, and that credit report requests actually require managerial approval. So here's a little hint for you. If you know that they did a credit bureau request, you can make sure, did they get a managerial approval? But it is another tool at their disposal, and this helps them identify past residences, employers, might even verify a competing lien holder. They might be able to tell balance due, payment history, as well as possibly identify property that may not be listed. So, bottom line, you might want to stress this to your client, how important it is to make sure that you have all the information, because with it, yeah, you can see what you can do about it. Maybe they don't qualify for an offer, but man, I'd sure like to know about that ahead of time before submitting anything. So for the purposes of this, we're going to use some hypothetical data, and we're going to start out simple. We're going to keep kind of growing this until by the end of this, you're going to have a really great understanding how to go through and work with this data for a taxpayer. There is, of course, the equity component, and there's the income component. So two sides of our equation. And this is one that we covered before in one of our basic course, but we just want to kind of just get you back into it here. So we're going to use a single taxpayer. And the trick here is how we figure out the value, that fair market value of the home. And that's what we're going to cover next, is we're going to start going through these. But when we do all of our work and come down to its values and say it's worth a market value of $150,000, and then the auto respectively 20, IRAs 10, we're going to take away the encumbrances against it. We're going to take away any tax that we have to have, knowing that just by nature of liquidation we have this tax bill. Come up with the equity side. Then we're going to go over and we're going to figure out gross income, and from a cash basis standpoint, in total income before any deductions on it. And then we're going to take a look at all of our allowable expenses and come up with a monthly excess value. So here's a little trick too. What if in some occasions we have a equity that is 0? I get this question, believe it or not, what about a negative number? You can't put negative. You have to. It's only up to 0. You can't use a negative or a subtraction. So we have a 0 amount in their equity, and we happen to have expenses that are a little bit more over their income, 0 income. Believe it or not, you do not have an offer. It may sound great. Hey, that's 0. 0 equity, 0 income, 0 offer, right? No, because legally, in order to make an offer, you have to have something to offer. They have to have some positive value, or it's not a legal contract. So think of that. If that's the case and that's your numbers, they're going to say that's a currently non-collectible situation. You've got to have some positive numbers there. So something to think of.